Good evening and hello. Like every year, we are now again on the threshold of hearing the budget speech and interpreting the budget documents. Media and economists make a lot of hangama around this event. Over time, however, major reforms have been accomplished. Around the year now, we see policy changes happening, and hence the unique aura over budget has been reducing over the last few years. All the same, it is important event affecting the financials of people, their families, their businesses, and the economy of the country as a whole. And hence, it becomes imperative to expect a few things and then dissect the budget once it is announced. This will be the first full budget from Modi 2.0. Given the tight fiscal situation and the slowing domestic growth, it would be a challenge for the FM to balance the two objectives and kickstart growth. Also, given the shadow of the global impact due to the coronavirus threat, the task of the FM has become a little more tougher. Modi government is likely to deviate from the policy of fiscal consolidation for the first time in almost 6 years and may go for higher fiscal deficit to boost growth in the budget on February 1. Given the fact that the first 2 years of any government sees most of the reforms, it is normal to expect that the reform thrust will continue at least till May 2021 and expect some big bang announcements or big bang reforms even in the budget. Now, of course, a lot can be done even outside the budget. It is not that budget is the only instrument where the reforms can be undertaken. But being a big event, one would expect some major policy thrust or announcements in the budget. Government needs to give a serious push to improve the business environment. One only hopes that the recent political reverses that the ruling coalition has seen does not bring down its enthusiasm to go whole hog into reform mode, even if it hurts some segment of the population temporarily. In the past, some FMs have tried to do too many things in the budget and try to appease a lot of constituents as much as possible. However, this time around, the FM should try to do less number of things which are for the overall good of the economy, even if they temporarily hit some portions of the population. Main focus should be on increasing investments and raising productivity, though it could take some time to show effect. So now, what are our key thoughts ahead of the budget? Of course, we will take Q&A at the end of the talk. Now, as far as fiscal situation is concerned, for FY20, lower revenue collections and disinvestment proceeds, which so far are less than 20% of the target for the full year, could be compensated by excess RBI dividend, expenditure cut in the last quarter, and subsidy rollovers. Date of receipt of telecom AGR payments could impact FY20 or FY21 fiscal deficit. So one is not sure at this point of time when the mobile telecom companies will pay up the AGR dues, how much of a time the telecom ministry is willing to give them or the Supreme Court will allow to be given. We expect FY20 to end with a fiscal deficit of 3.5 to 3.7% of the GDP versus the original estimate of 3.3%. For FY21, we expect the fiscal deficit to be targeted at between 3.4 to 3.5% of GDP. Fiscal consolidation roadmap may be deferred by one more year. However, given the effect of higher fiscal deficit on interest rates, on ratings and on capital markets, it is unlikely that FM may budget a very high fiscal deficit either for 20 or 21. Though economists hope for a cleanup of the fiscal situation by bringing all off-balance sheet items on the books, for example, borrowings by NHAI or Food Corporation of India, it may not happen this time around in this budget. Now, bond yields. The 10-year bond yields, which are currently between 6.5 to 6.6%, could remain high for some more time due to inflationary and fiscal pressures and large amount of GSEC maturity which are due in the next 1 or 2 years. Ongoing sluggish growth in revenues have raised the possibility of additional borrowings in Q4 of this fiscal. If the growth does not resume due to any reason, including global events, the pressure on yields could reduce, meaning people could flock towards debt. Demand for debt papers may increase, and that is why the yields on the debt papers may come down. Government should tap the foreign borrowing route gradually, which would reduce the pressure on domestic yields. Now, economic growth. FY20 nominal economic growth could come in at 7.5%, and real GDP could come in at between 4.6 to 4.7%. For FY21, the numbers could be 10% and 5.3 to 5.5% respectively. Some green shoots are visible in terms of revival of growth. Better finance availability is now seen. The festive sales have been quite good. Agriculture output may also be quite high due to the high Rabi sowing as well as good water levels across the country. Scrappage policy for commercial vehicles may be announced. However, it may be implemented in a staggered manner, and the fiscal deficit, the fiscal impact of this policy for a particular year may be limited. Personal tax rates. Now, the biggest expectation in this budget lies around this topic. Though expectations are very high on a sharp cut in personal tax rates following the corporate tax cuts which were announced in September, we think that two back-to-back large giveaways in quick succession is hoping for too much. If at all, some tinkering of tax slabs may happen, which may result in rupees 5,000 to rupees 8,000 benefit per individual. Long-term capital gains tax on equities and equity mutual funds may be abolished. Of course, the holding period also may be increased from 1 year to 2 years. The whole purpose behind levying long-term capital gains tax has not been achieved because the revenues that it has resulted in is very minuscule so far. On the other hand, it dampened investor sentiments to a very large extent. So there does not rest a case for continuing with the long-term capital gains tax. Dividend distribution tax may be abolished, but recipients of the dividend may be required to pay tax on the whole of the dividends received by them. Infra spend. Infra spend, essentially the capital spend will grow in line with the growth in the nominal GDP. A new scheme to replace the existing Uday, the power sector, may be announced to improve power distribution, ensure power 24/7, reduce T&D losses, and enforce discipline among the state utilities. Government may take incremental steps to revive the real estate sector. This sector has a high multiplier effect on the economy. This may be done by expanding the definition of affordable housing, by providing higher income tax deduction and improving the liquidity to the real estate players. Rural and social spend. Incrementally, no large allocations are expected. If at all, some substitutions may happen. One policy may be stopped, and in place of that, another policy may be announced. So, overall spend on rural or social purposes may not increase materially. We think that we need to spend the allocated monies well and increasingly focus more on the human development, which is the education and healthcare part, and giving the other infra spends a little less importance. Divestment and privatization. This is one area where the focus of most foreign investors will lie this time around. The FM may present a credible privatization program and asset monetization plan. The government has to take some hard decisions regarding the ownership of even the erstwhile strategic PSUs. For FY21, we think divestment target could be fixed at 1.5 lakh crores compared to the target of 1.05 lakh crores for FY20. This may be due to the impending privatization of Air India, BPCL and Concor, which have already been announced and which may not finish by FY20 and may get postponed to FY21. Tax leakages. GST frauds may be termed as a non-variable offense. The Ministry of Finance is looking to expand its tax base in the by plugging loopholes in the law, especially in areas of tax exemptions, input tax credits, and concessional tax schemes. Indirect taxes. Inverted duty structure may be rectified partly. Import duties may be hiked on some electronics, electrical goods, chemicals, handicrafts, etc. to protect the domestic industries. Steps to help banking NBFC sectors to enable them to provide more credit to real estate, MSME and other sectors. Lenders may be allowed one-time restructuring of certain real estate loans, like projects which are stuck due to lack of approvals or lack of finance. A TARP-like program, which is Troubled Asset Relief Program, which was prevalent in the US, could be introduced for restoring the flow of liquidity to the businesses and give an extension to the lenders for recovery from certain sectors. For 50 large NBFCs, government could defer principal repayments for a specified period. PSU insurance companies may need capital infusion for meeting solvency requirements, and that may be provided. FDI limit relaxation. FDI limits may be hiked in some sectors, including aviation, up to 100% to attract foreign investment. Now, the budget's effect is normally worn off in within 2 or 3 days of the budget. We feel that the markets may slide ahead of the budget on apprehensions of the budget or provision, and also due to the coronavirus scare. However, post the announcement of the budget, once the uncertainty is out, markets may bounce and rise towards the earlier high levels. However, this rise also may be sold into. Now, to look at the stock watch list. The sector that could benefit the most includes consumer facing due to the thrust on consumption by providing tax reliefs and improving liquidity. This includes auto, FMCG, consumer durables. Banks and NBFC sector could also benefit due to the steps expected to be taken to alleviate their problems in terms of liquidity, NPA recognition, and or capital infusion. Cement sector should benefit due to infra and real estate thrust. Real estate sector could benefit due to the emphasis on alleviation of the issues with the sector being within the sector wherever the projects are stuck. Now, in terms of specific stocks which could be watched during budget time, we have shortlisted 10 stocks which are ACC, Dilip Buildcon, ICICI Bank, Interglobe Aviation, ITC, Kalpataru Power, Hero Motorcorp, Radico Khaitan, SBI Life, and Shriram Transport Corporation Finance. Now, out of this, we already discussed about cement, infra, banking, aviation, ITC. Now, ITC, there is a fear that the duties on cigarettes may go up substantially because of the fiscal pressure, but we think that may not happen. If at all, a very minor rise in the taxes may happen. Post that, ITC may see a relief rally. Then we have also discussed about power. Two-wheelers again are a beneficiary of consumption. Radico Khaitan again consumer facing. SBI Life is an insurance stock, and Shriram Transport Finance is a NBFC. So this could benefit out of the reliefs which are expected out of the budget. We at HDFC Securities are fully geared to cover and analyze the event and give our comments and recommendations. We have already issued a few technical reports, derivative strategies, and pre-budget strategy note and stocks watch list. These are available on our website under the special budget page. We will continue with our coverage even after the budget with our reports, recommendations, and webinars. Now we will take a few questions. Mr. Akash Ramani has asked any specific recommendation for 2020 sectoral wise. So we have already given this in terms of our stock watch list. You can go through them. What are the expectations from each sector, and what is the benefit? Which companies under our coverage will benefit out of those expectations if those expectations materialize? Has been given in our stock watch list report, so you can refer to that. Corporate Sunil Parwani has said that corporate tax reduction has not resulted in growth or investment. Should FM withdraw and provide personal tax relief to increase growth? Now, while what you say is right to an extent, it has not resulted in any growth or investments, but it was never intended to see an immediate impact. There was also always going to be a lag impact. Secondly, withdrawing such a large giveaway in such a short period of time will not look good on the part of the FM in the face of the investors, whether the local or foreigners. Personal tax, to what extent personal tax giveaways can be given is another debate that we can enter in. This is not the right forum for that. India being a country where only 6% of the people are paying income tax, you cannot expect more and more tax relief and more tax exemptions and increase in the tax slab, because tendency of Indians to come under the tax net is low. So if you give them a little more leeway, more and more people will try to escape the tax net. So giving a very big giveaway on the personal tax rate is neither practical nor socially a good thing to do. So I think at the most these tax slabs may be tinkered with, and that may result in some reliefs to taxpayers. Then can you please repeat the stocks? Okay, now this is by Kavita Nathani. The stocks I will repeat again: ACC, Dilip Bilcon, ICICI Bank, Interglobe Aviation, ITC, Kalpataru Power, Hero Motocorp, Radico Khaitan, SBI Life, and Shriram Transport Finance. Individual stock queries, we are afraid this is not the right forum, so we will not be able to. Any recommendation on IT and technology? Now, IT and technology sector may not be impacted much by the budget, except to the extent the dividend distribution tax, if it is abolished, then what will be the way the IT stocks or companies will adopt to distribute cash? Previously, this dividend was a good way to distribute. Then people shifted to buyback. Now buyback also was taxed last time around. So now, if dividend distribution tax is abolished, will people go back to dividends? That is the question. Apart from that, I don't think IT sector will be impacted much by the budget. Pharma sector, we have mentioned any relief for pharma sector. The expectation is that for pharma, the weighted deduction for R&D will be continued or increased. So if that happens, then it will be welcomed by the pharma sector. Apart from that, higher allocation to healthcare schemes by the government will also be good for in terms of demand, creating demand for medicines. What is the outlook for auto sector? Now, auto may we are expecting scrappage policy in some way to come. Of course, not in a very it may not be a very big benefit. It may be a staggered kind of implementation. As far as other parts of auto is concerned, I think two-wheelers will benefit if consumption, if more money is given in the hands of the individuals and rural people. So that is one thing. Four-wheelers, I think, may take a little more time to revive. Railway stocks profit should be booked. Sunil Gandhi. Yeah, typically every year, PSU and rail stocks move up ahead of the budget, and around budget time or just before the budget is announced, there people take profits. So that is what I think traders can do similarly this time around also. Unless we see a very big allocation to railways, and post that, even after the budget, the rail stocks continue to perform, which is not, it does not seem very likely as of now. I think we'll take one or two last questions. Now there is one more question by Satinder Bedi. Where do you see large cap and mid cap indices over the next 6 months? Now we have seen polarization in the market. Large caps have done very well over the last 1 year or so, and mid cap and small caps have severely underperformed. Over the last few weeks, small and mid caps have started to catch up, and this catch up process could continue for some more time. Uh, but now in the small and mid cap space, you will have to be very careful. In the earlier days, the entire small and mid cap space used to rally together. But over the last 3 or 4 years, there have been technological, regulatory, financial disruptions, and also there have been corporate governance issues in a lot of companies. So you will have to be much more selective if you are planning to buy small and mid cap stocks, and keep taking profits at intervals, because after every run up, we could see a good amount of correction. So you will have to continuously do a proper asset allocation among the capital segments: large cap, mid cap, small caps. So for example, now large caps have run up quite a bit, so there they may take a breather, they may correct a little. Small and mid caps may rise a little more, and then again they may take a breather, and we will keep seeing switches between the two. So net large caps have run up, but they will continue to run up as long as the large institutional money keeps coming in, and large amount of SIPs continue to come in. Going by the way these small and mid caps have underperformed, the mutual funds don't want to take that risk of moving a large portion of their monies into mid and small caps. Last one we'll take now. Any such is by Shashank Shah. We have a good amount of research also on mutual funds. Our website, in the research section, you will go to mutual funds. There we have lump sum ready reckoner and SIP ready reckoner. You can go through that. Category wise, we have given our preferences in terms of schemes. From there, you can take your pick and invest. I think that should be all now. I hope this webinar was useful, and hope you will make use of our forthcoming coverage on the budget. Thank you.